well
yeah, I mean, if you're selling like if you sell clothes versus goods, and if you sell to the high end or the low end,
yeah.
It feels like we're in that universe.
Well, it's hard to answer the question because
goods and if
lots of things are discounted. If you look, especially this weekend, the high end.
Oh, for Labor Day weekend?
Yeah, and the high end is extremely high end. And I think people wear, less expensive if it goes cool and more expensive. But
I mean, when you look at the results, let's just say this has been a big week for retail earnings. Five Below, they beat. Stocks at a 52-week high. Dollar General, they raised their guidance. It's like a theme, right? The lower end seems to be doing
100%
better than the higher end.
Well, I don't know the earnings, but lower prices are the vogue for a number of years now because you can always get a deal, even with the higher priced players.
And is that the way it's just going to be? I mean, especially in an environment where now you have people who do jobs that you used to do, thinking about how you deal with tariffs in an environment, margins and pricing, and
it's impossible. We have not seen the last of the tariffs. China's not announced yet. We're flying blind. And how do you run a business without knowing the controllable costs? And, I don't think the worst has come yet, in my opinion, because retails don't seem to be as high as they might be. And I know Walmart warned, and a lot of people, Target warned about retails. It's a very difficult, challenging environment because of all the variables.
What are you guys doing at Alex Mill? You don't run the business, but you're chairman. Are you eating the cost of higher goods? Are you passing it on? How do you deal with it?
How do we deal with it? Use our judgment, our intuition, our gut, which are three important characteristics. Here's what we're doing. We're looking at what tariffs have kicked in. We're evaluating what prices are worth. We're known as a very fair-priced brand. A lot of brands are much more expensive, and my whole career has been style, value, quality, and not clothes that go out of style.
No, but you have to make very hard decisions,
yeah,
right?
We do.
If you come into the business and you say, I'm a hardliner on fair price, and now my wholesale costs have increased dramatically. Your microphone just fell right down there. If you want to put it right there. Yeah. Okay. If you say I'm a hardline price guy, but now my wholesale costs have increased dramatically, well, some's got to give.
So what happened on the way here, I visited a big department store. And I looked at our.
You know what? I did this for one guest before, and I'm just going to do it again. And I don't care that it's live television because we're going to make it work because I want to hear what you have to say, okay?
Well, I called the office on the way here because I was reading some things about prices. Our number one sweater, for example, we only raised the price $3 because we negotiated a good deal. So I called the team. I usually get a little pissed off or upset. I said, is that we raise a price? And then they answered the right way. It's style by style. And I wish I knew the cost of our goods. How do you run a business where you can't control the controllables? Is this okay, by the way?
Yeah, it's all right. I mean, well, if you can hold on to it.
I'll hold on.
Sometimes it's tough. Okay. I mean, it is what it is. Yeah. Live television sometimes isn't easy, Mickey, but what can I tell you? That's fine. No one cares. They'd rather hear from you. It doesn't matter. Let me ask you this. The controversies that have been playing out lately, Sydney Sweeney. Retailers make decisions on who they want to advertise with and the kinds of messages they want to impart on their customer base. You said, you weighed in on this, which I found. You said on a podcast that American Eagle, quote, screwed up and should have apologized for the ad, which was highly criticized. Well, half the population right now is like, apologize for what? Like, you didn't do anything.
Well, they didn't.
The other half is like, well, I'm offended. And
Right.
as a CEO,
Oh, shoot. What's going on here?
don't worry about that.
Okay.
As the CEO of a company that's trying to advertise in that environment, why did you weigh in?
Well, I was on a podcast, I guess, that day. Why I weighed in? First of all, Jen Foyle called me last night. Not about she's the president, and we talked about Sydney Sweeney. It became a big news thing, and it wasn't worth it. And I felt that if they apologized quickly, it would be fine. At the end of the day, it doesn't mean a damn thing to their business that they did that, in my opinion.
But maybe they didn't think they had anything to apologize for. That's like what the whole controversy has become. I don't ask you this to kind of relitigate the issue, but if you're the CEO of a business making decisions in what is a highly polarized environment that we live in, do you think twice? How do you deal with that?
I always say, and I got a debate regularly relative to AI, judgment and instinct and intuition on everything, even goods, that calls the day. So I thought about it. If they apologized, who cares if right or wrong? The world likes gossip and stuff like that, a total overreaction. And then they said it was gender wrong. No, I think it disappears. It's gone forever.
Do you hesitate in this environment to change a logo?
Oh, well,
that was Cracker Barrel. We saw that. I mean, do you hesitate to do anything that could cause a storm on one side of the political aisle or the other?
I don't know anything about Cracker Barrel. When I read that article yesterday, I said, why? First of all, the new logo's ugly. The old logo is homey, and it's their definition of who they are. You don't just willy-nilly. And you know who probably changed the logo? Some consultant was paid $1 million. They drew a logo. And all that relates to the vision of every business. What should it look like? And look, MSNBC, I don't know what names they rejected to call MSNBC. It's not emotional. It's not connective. And, look, I had fights in my old company about Old Navy, which I named after a bar in Paris as I was driving by. I said to Maggie, we didn't have a name. I said, that's the name, Old Navy. Now, the board didn't like it. 2 consultants and $5 million later with the worst names. And it opened up Gap, Warehouse, Old Navy. And how do you can't explain. If you know, you know. I live by that thing now. People who know, they know. I don't know much about technology, so I don't know if you know. AI, by the way, I have debates with my AI friends. One is on the board. And I say, AI, and then there's arguments. It's fine. I said AI doesn't have emotion. It won't pick best colors. It won't design the clothes. It won't negotiate with the factory. So I feel my job's pretty safe. I know what it's going to do. But look, you read about it every day. I feel I'm not a technologist, forgetting I spent many years on Apple. But, it's America.
We'll leave it there. It's good to catch up with you. Thanks for coming by and see you in person.
Thank you.
Don't leave yet.
Okay.
We'll have to read the teas first. This is Mickey Drexler. Up next, the vaccine makers are getting hit in today's session. We have a report on that developing story coming up.
now.
We are back. Vaccine stocks are in focus today. HHS Secretary Robert F. Kennedy Jr. continues to dramatically overhaul the CDC and U.S. vaccine policy in general. Angelica Peebles here with more on these moves today. Angelica.
Hey, Scott. Well, the White House says that President Trump has fired CDC Director Susan Menares, but lawyers for her are continuing to dispute that she was legally fired. So a little bit up in the air there. But a former CDC official who spoke to Menares said that she was asked to fire leaders at the agency and to rubber stamp recommendations from the CDC's Vaccine Advisory Committee that flew in the face of science. Meanwhile, 4 other CDC officials resigning this week, and former CDC Chief Medical Officer telling MSNBC that she and some colleagues had been pushing for more input on an upcoming meeting of the CDC's Vaccine Advisory Committee. And when the CDC's director's attempts were denied, she and her colleagues decided that they couldn't stay, and that's why a few of them resigned. So that committee, the ACIP, is scheduled to meet in mid-September, and they're supposed to discuss COVID boosters and routine shots like MMR, that's of course the measles vaccine. And Senator Bill Cassidy is calling to postpone the meeting given this shakeup, but it's hard to see that actually happening. And vaccine stocks are under pressure today. Take a look. All of those, Merck, Pfizer, Moderna, Sanofi, GSK, all in the red, Scott.
Angelica, thank you. Angelica Peebles up next. We track the biggest movers into this close today. Christina Partsinevelos is standing by with that. Top of your list is what?
A food giant having its worst day since the 80s. You remember that time well, right, Scott? Well, reveal who after the break.
now and make it count.
All right, we're less than 15 from the bell. Back to Christina now for the stock she's watching. Tell us.
Hormel having its worst day since 1987 after a profit miss and weak current quarter and fiscal year guidance. The interim CEO also cited high commodity costs and the profit miss and said those near-term pressures are really going to hurt the company's fourth quarter. The stock is trading at levels that we haven't seen in more than 10 years, down 12%. On the flip side, Datadog is the best performer on the S&P 500. It comes after strong earnings from Snowflake, who we discussed remember, not even 20 minutes ago. It seems that the cloud security company is just rising in sympathy right now, up almost 7%. And then you've got Brown-Forman, another laggard. Despite a profit beat in revenue that came in line with estimates, the spirits maker did reiterate its 2026 outlook. But they said that challenges still remain on the alcohol sector as a whole, and that's because, why? Consumers are shifting away from booze to healthier options. Brown-Forman CEO said in the release that the company remains confident in their ability to create long-term value for shareholders. They're still losing sales, though, down 5%.
Christina, thank you very much for that. Christina Partsinevelos still ahead. Dell and Affirm, they reported OT. We're going to get you set up for those reports coming up.
Free consultation.
the Closing Bell Market Zone. And we're getting you set up for all the key earnings in overtime. Christina Partsinevelos is watching Dell. Mackenzie Sigalos covering Affirm. Plus, we have BTIG's Jonathan Krinsky. He's going to break down these crucial moments, ones in which are going to be record-setting. They sure look like that, Jonathan. We're on pace now for record setters for all three of the majors. S&P 500 above 6,500 for the very first time ever. Technically speaking, this market looks pretty darn good, doesn't it?
Yeah, so we came into August with some pretty decent divergences between breadth and the indices, and divergences always resolve one of two ways, right? They either you have the indices catch down to the weak breadth, or you have breadth catch up to the indices. And we saw the latter on Friday after Jackson Hole. As of Friday's close, you had the best reading of Russell 3000 stocks, which is essentially the entire stock market. You had the best reading there of the year, right? So breadth certainly caught up to the indexes. And so what we've been saying is, that's kind of a level to trade against, where we kind of broke out from at Jackson Hole, which is around 6,400 on the S&P 500 to keep it simple. So breadth has been improving. As long as the S&P is above there, I think the bulls maintain the upper hand. I don't know if there's a ton of upside on the index level, but I think that's when you want to start looking below the surface at some sector rotations.
All right, good tease, because we'll come back to you for a play that you think could be on the verge of a breakout. We'll go to Christina, though, first. Dell, after the bell, what do we think?
It's a tale of two businesses. You've got traditional PCs that still drive roughly half of the company's revenue, but that segment faces ongoing pressures from declining prices and margins. There's a possible delayed upgrade cycle. Windows 11 and AI PCs really aren't expected to deliver meaningful upside this quarter. But the real story is Dell's AI server momentum. The company is winning big with key customers like xAI and CoreWeave. Microsoft is also ramping up orders among hyperscalers, adding fuel to the fire. You've got Dell's key manufacturing partner, Wistron, who just reported May-July revenue surging 56% quarter over quarter and more than doubling year over year. So that is a good sign for Dell. Looking ahead, also recent licensing approvals for chip exports to China could actually drive demand for 300 to 500,000 additional GPUs annually for AMD and NVIDIA. And this is according to Mizuho, chips that need Dell's servers to run. So all of these signs could point to some strength, I should say.
All righty, thank you. Thanks for everything today, too. Christina Partsinevelos. Mackenzie, how about Affirm?
So, Scott, Affirm shares are heading into the print up 28% this year and climbing again today. The street is expecting a top line of $837 million on earnings of 11 cents, which would actually mark a slowdown in revenue growth from 48% last year to 27% now. A big question this quarter is Walmart. Deutsche Bank notes it accounted for about 5% of Affirm's volume before shifting to rival Klarna. Morgan Stanley says the key concern is whether that loss weighs on guidance, though they expect the impact to be more muted than feared, in part because roughly a third of those transactions happen through Affirm's own app and card, not from Affirm's direct integration with Walmart. And at the same time, Affirm has been gaining ground with partners like Amazon and recently expanded its integration with Google Pay. Scott?
All right, Mackenzie, thank you very much for that. Mackenzie Sigalos. Back to Jonathan Krinsky now. All right, so this broadening story. Note today, poised for a breakout. Energy has been one of the worst performers.
Yeah, so if you look at some of the risk ratios like cyclicals versus defensives, those ratios have broken out to year-to-date highs. That's a good sign for risk at the moment. So I think you want to avoid some of the defensives, the low volatility names, but what you want to be looking for is some of the cyclical areas, and energy really fits that bill. It is one of the worst performing sectors on the year. If we're talking about the XLE ETF, there's an unfilled gap from April around $93. So we think that gets filled. I think it's the only sector that hasn't filled its April Liberation Day gap. So that would be kind of a near-term target. But I think when you're thinking about the commodity itself, crude oil, large speculators have the smallest net long position relative to open interest in about 15 years. So I think sentiment is pretty skewed, lopsided here, and we're just starting to see breakouts in a lot of the energy charts. So we look at the XLE, the XOP, those sort of names here.
All right, good stuff, Jonathan. It's been good to have you. I'll let you go as we track this market here into the final stretch. And it looks to be a record setter across the board, too. And what's interesting about that is NVIDIA is not going to play much of a role at all in it. NVIDIA is down following its earnings. A lackluster response from the stock post-earnings, but really a massive run into the number, so maybe that's not too big of a surprise. Elsewhere, the other mega caps are higher. It's probably why the NASDAQ is going to be the outperformer today in what has been a really solid day across the board. S&P looks to close above 6,500 for the very first time ever. It's going to fight it out to the finish, too. As the bell rings us into this close, I'll see you tomorrow into overtime with John Ford.
That bell marks the end of regulation. Why Texas ringing the closing bell at the New York Stock Exchange? Array Technology is doing the honors at the NASDAQ, and it was another record day on Wall Street. Major averages all closed at new highs, and it was a rare day this week where small caps underperformed. Communication services driving the rally today. Trade Desk and Alphabet, two of the big winners. Alphabet continuing its huge week to close in uncharted territory. And investors digesting a mixed bag of retail earnings. Burlington Stores and Five Below higher on earnings beats. Bath & Body Works, Urban Outfitters, and Best Buy all under pressure after their reports. And that's the scorecard on Wall Street, but winners stay late. Welcome to Closing Bell Overtime. I'm John Fort. Morgan Brennan is off today. Ahead on Overtime, we've got more retail and tech earnings as we get set to break down numbers from Gap, Ulta, Dell, Affirm, and Marvell Technology. Plus, we'll get the trade on software stocks, which have been surging this week after underperforming the overall tech sector this year. But let's get to Christina Partsinevelos now at the NASDAQ with a closer look at some of the themes driving today's rally. Christina.
I would say NVIDIA earnings didn't deliver fireworks, but with stocks at all-time highs, no major sell-off is basically a win. Tech showed impressive breadth, though. 70% of the S&P information technology stocks actually closed higher compared to just 40% for the broader index. So we're seeing some of that concentration again. Cloud names led the charge. Snowflake surging on better-than-expected earnings, up closing, almost 20% higher. MongoDB also rallied 7.5% after posting its best day on record yesterday on an improved earnings outlook. Software infrastructure, like you talked about, John, is just making a comeback. And then NVIDIA barely closed in the red, but the stock's still up 45% over 6 months. Very impressive. The semiconductor SMH ETF closed higher, driven by Micron. Micron did close, 3.5%. There was improved PC market comments coming from HPQ, and then reports saying that it could steal mobile share from Samsung, coming specifically from DigiTimes in Asia. And then you've got Broadcom jumping about 3% after Oppenheimer raised its price target ahead of earnings next week. And lastly, you've got CoreWeave climbing after management said in a Deutsche Bank conference they've signed expansion contracts with both hyperscaler customers over the past 8 weeks. I wanted to mention that because that is why you're seeing the stock close 6% higher today, and it didn't really get any airtime today. John?
All right, Christina, thank you. And mentioned earnings. Autodesk has crossed. We are going through it. Stocks popping more than 7% at the moment, so keeping our eye on that. Also, a little correction here. The NASDAQ dipped at the close just enough to not be at a record. All right, enough about stocks for now. Let's get to the bond market, where longer-term yields are falling.
earnings and the broad that can continue, then I think the market can continue. But as soon as we start to see chinks in that armor of earnings power of individual companies, then I think people will start to call this rally into question.
Well, let's take a break here for Dell's results. It first popped and now it's falling down about 3%. Christina Parks-Nevelis has the numbers. Christina?
Yeah, Dell did beat Q3 expectations with $2.32 earnings per share on revenues of $29.8 billion, both above estimates. However, the company saw weakness in its PC segment, which really represents at least 50% of its exposure. As well, there was also some weakness in storage. The bright spot, though, was AI servers. Dell's COO noted in the release they've, quote, shipped $10 billion of AI solutions in the first half of fiscal 2026, surpassing all shipments in fiscal 2025. With demand remaining, quote, exceptional. The company did raise its AI server guidance to $20 billion for fiscal 2026. But despite that, the outlook, you had a weak Q3. Dell issued weak Q3, but they did issue strong full-year EPS guidance, signaling a lot of strength in the fourth quarter. And this really reflects seasonal patterns for Dell in their storage business, which typically performs well at year-end, plus Dell's IP, intellectual property portfolio, also driving higher margins. So it's a little bit of a mixture bag, but AI is doing a lot better. And you see the shares are turning around.
Yeah, I mean,
John?
they're turning around and around and around, up and down. It's a
People
live
don't know.
one.
Well, what do they prefer, the PC market or the AI server comments?
Well, yeah, and people, of course, placed their bets ahead of time, so lots of tugging in either direction. Victoria Green, what do you make of the not only NVIDIA earnings that we had last night, but then potential software turnaround? We saw some pretty strong results out of Autodesk just now, guidance as well. That's one that had been a little bit mired in some other operational issues that seem to be clearing up. And then there are a number of other names in the software space that have popped lately after a difficult start to the year.
Yeah, we've liked the software space beyond Palantir because who hasn't liked them, right? They've been the leadership in that space. It's great to see these other names participate, yet anything from Snow to Autodesk. And we're seeing now that people need to implement AI, and that should be a nice tailwind to all of these software stocks because suddenly they're going to be the ones potentially picking up more add-ons, maybe sharing some more modules across their enterprise base and selling a little bit more. So we are bullish on the software sector. We'd like to see it expand beyond Palantir because some of these guys have really been lagging relative to their peers in the AI trade. We think chips still have a place, but software is going to be kind of the next stage as you look to implement that. You have your infrastructure. You still have plenty of legs, in my opinion, on the AI infrastructure play, but maybe also be looking at software because that's the next stage and actually implementing it and selling it across enterprises. So we're bullish on that. We love the broadening out. Autodesk should have been up because, we know construction is huge with all of this AI spending, data centers, all of this build out. We are extremely pleased that they did as well and guide as well as they did, and they should be following the construction trend. So that one was par for the course. Dell's a bit of a surprise. We were hoping the PC market didn't bite it the way it did. We were hoping for stability in that sector, maybe a little growth, and I guess that was a bit too rosy of an expectation. But they're a huge beneficiary of NVIDIA. And NVIDIA, to me, if you listen to the commentary from the CEO, the Blackwell system is going to continue to sell as many as they can produce, maybe some regulatory risk, but they should be able to sell now in China. And their expectations included zero China revenue. So for those saying, well, NVIDIA beat a bar and their guidance and their raise was right where it should be, I think they left themselves room to beat in the second half of the year.
Okay. Marvell looks to be out. We're going through that one. It was down 7%, but Ulta Beauty is ready right now. Melissa Repko has those numbers for us. Melissa?
Hey, John. So shares of Ulta are rising after it raised its full-year outlook for both sales and for earnings. It reported revenue of $2.79 billion compared to Wall Street's expectations of $2.67 billion. And on the earnings side, it reported earnings per share of $5.78. It's not clear yet if that is comparable, John, but same-store sales were up 6.7%, and that was more than double the street was expecting. It's also worth noting here that Ulta is a stock that investors have been paying attention to and liking because it doesn't have as much tariff exposure. Last quarter, they spoke about how only 1% of their merchandise they sold last year was directly imported. So that's an interesting detail to note, John, and it makes them stand out from other retailers.
Melissa, thank you. Now let's find out what's going on with Marvell Technology, those stocks under pressure. Christina Parks-Nevelis, how do the earnings numbers look?
It has to do with the revenue line. So earnings per share came in at 67 cents adjusted, which was a 1 cent beat compared to estimates. And this is a company that makes custom chips primarily. The revenues for the quarter came in line with estimates, but it's the Q3 revenue guide at $2.06 billion, which was slightly less than what street analysts wanted. We have to keep in mind, too, the company did post a sale of their auto Ethernet business that actually just closed in the quarter, so that doesn't necessarily mean a clean guide. And there has been some worry about share loss with Amazon, one of their customers, too. But you can see shares dropping dramatically, 8%, most likely on that Q3 revenue guide that was weaker.
All right, eager to hear more about that. Christina Partsinevelos, thank you. Kara Murphy, back to you. We don't have any more earnings lined up and ready, do we? Can we go back to Kara Murphy? I can't. All right, Kara, speaking of broadening out, we were talking about that earlier. Industrials, how did those look for you after the earnings season we've had so far?
I think it was very interesting to see those earnings coming through after the second quarter. There's been so much focus on, AI earnings generation, but this was really the first quarter where we started to see industrial companies talk about higher demand, backlogs, many of which is related to kind of AI, but it's starting to see those impacts move out beyond the companies that are sort of directly impacted to others that support the infrastructure around AI. And I think over the next couple of quarters, again, to this theme of being able to continue to support this rally, we have to see this AI productivity miracle start to show up in other sectors of the economy and ultimately to companies' bottom line.
All right. Thank you for that. Well, looking at a firm, it looks like it has just crossed. We are going through those numbers. It's not moving too much yet, but Victoria, I wonder what you think about the consumer right here and talks of some stretch credit. And there have been a bunch of people who have equated buy now, pay later with irresponsibility. I wonder if, in fact, as the thesis of these companies, these buy now, pay later companies, argues that they might have some better math and some better technology for figuring out creditworthiness. Are we going to get more detail and insight into whether that's the case from these reports?
I think so. I think there is a stigma to buy now, pay later, but this is much different than like pawning your ring to pay a bill, right? This is basically a different type of credit card. So obviously people never like change in competition. So your established, your Visas, your MasterCards, your Amexes are saying, oh, this is terrible. People shouldn't be using this to buy things. How is that different than putting it on your Visa? And so I look at this and I love a firm strategy. I'll be interested to look under the hood, see what happened here, how shares aren't reacting. Expectations were high. They were expected to slow growth a little bit year over year. But they had their new Affirm card, maybe it's the Walmart drag, but they have their other strong partnerships. They're now in Google Wallet, Apple Pay, they make it very easy now to utilize their platform. And so maybe I'll have to see how they missed. Was it gross merchandise value a little bit low? Be extremely interesting. But the consumer itself does seem healthy. I mean, look at Ulta. We've had some strong retail resorts. You had Dick's Sporting Goods this morning. People are still spending on sports. People are still spending on makeup. They're just being pickier about how they spend. And so I think that's hurt some retailers and helped others. And so this is no longer a rising tide lifting all retail boats. It's you have to have a product somebody wants to buy. You have to have an offering people want to come visit. They go to TJ Maxx now instead of Target, and so for Ulta, they picked up while Estee Lauder lost a little bit. And that's been par for the course across this earnings season. Yeah, between Dick's and Ulta, the consumer is healthy and pretty. Victoria, Kara, thanks to you both. Affirm earnings, as I mentioned, are out. Let's figure out what's going on with these numbers. Mackenzie Segalos has them. Mackenzie.
Hey there, John. So Affirm shares down about 1% in after-hours trading, despite beating on both the top and bottom line. You've got EPS coming in at 20 cents. The street was looking for 11 cents. Revenue at $876 million, up 33% from a year earlier. The street consensus was $837 million. We're also seeing a beat on GMV for the quarter. That's a key metric. Looking at the total value of transactions coming in at $10.4 billion versus the $9.61 billion expected. What might be weighing down on sentiment a little bit here, although I'm seeing shares reverse course to the upside, up 2%. We're looking at an implied revenue guide of $3.86 billion, which is roughly in line with estimates. But I'll keep going through this, and we've got the call starting in about 40 minutes, John.
Indeed. Another one that's moving a lot. Mac, thank you. Now, Gap earnings are out. Courtney Reagan has those numbers. Court.
Hi, John. Yeah, so Gap earnings are out, and it does look like shares are moving all over the place here. So for the quarter, Gap putting up an earnings beat of 57 cents. The street was looking for 55 cents. So that's a beat. Revenue's missing slightly at 3.73 billion. The street was looking for 3.74 billion. Comparable sales, they did grow 1%. But that is about half of what the street was looking for. If you break down by brand, Banana Republic very strong, much more than expected at 4%. The street was looking for that to be flat. Athleta is down 9%. Now, it's their smallest business. And there is weaker than expected gross margin at 41.2%. The street was looking for 41.9%. Looking at the full year outlook, the company is reaffirming its full year net sales growth outlook. And then they're giving us some details about operating income and sort of the hit that tariffs will have there. And I think it's worth explaining that I spoke with CFO Katrina O'Connell, and she said that the new operating income guidance does assume a $150 million to $175 million negative tariff impact, or basically what it's not able to mitigate. That is up from May's assumption of $100 million to $150 million. And as a part of its mitigation strategy, Gap did bring in some inventory early, which she says is partly why you see that number up about 9% year over year. And I also spoke with Gap CEO Richard Dixon, who said that it is expanding its manufacturing in areas like Guatemala, Mexico, and Haiti, again, to help offset some of that tariff impact. And when it comes to pricing, Dixon said they're making targeted adjustments with pricing, as we always do, but also said that as our brands get more relevant, it is increasing our price elasticity. We're driving higher sell-throughs at full price. We do have less discounting as a result. So shares bouncing all around as we wait for more color from the call for shares of the Gap. John, back over to you.
Yeah, it looks like mostly a drop here. Court, is your interpretation thus far? Of course, we have to listen to the call and to an interview coming up on CNBC, that this reaction has to do with that tariff impact surprise, perhaps?
I think so. And look, I think we all know, that it is a fluid situation, but we also know that earlier in the year, companies were having to make some assumptions when they were going out on a limb and putting out these guidance forecasts. And while China is still holding at 30% right now, and that was what was assumed in May for many of these retailers and what they're still assuming, when it comes to the rest of the world rate, that one is what's different. For example, Victoria's Secret this morning said that one had been an assumed rate at 10%, and now it's at 20%. And I think that's also what we're looking at here for the Gap. It's sort of that outside China area that is a little bit higher than it was before. The good news, though, for Gap, like most other retailers, is a lot of it is being able to be mitigated, but of course, not all of it, which is why I think it was important to give you some of those detailed numbers from the CFO.
Got it. Courtney, thank you. Speaking of, don't miss Jim Cramer's exclusive interview with Gap CEO. That's coming up 6 p.m. Eastern on Mad Money, and we're going to have much more on Gap's results next with a top analyst. Elastic shares, meanwhile, popping higher after an earnings beat. We're going to hear from the CEO coming up, as that's up 17.5%. Plus, with the S&P 500 closing at yet another record, we're going to break down which sectors could win big if this rally broadens out. Overtime's back in 2.
for certain.
Welcome back. Mind the gap. Shares of the retailer lower after an earnings beat, but revenue miss. Let's bring in Dana Telsey, CEO of Telsey Advisory Group. Dana, this seems like a dramatic reaction. Does this have to do with the revised tariff expectations?
That's what it is due to, because when you take a look at the earnings, as you mentioned, they came in a little bit better than the consensus numbers. You did see the store sales weaken, down 1%. Online was stronger, up 3%. But the weaker gross margin with the merchandise margin impact, in the call, the discussion about tariffs will be front and center, along with hearing about the momentum of each of the brands. The Banana Republic brand was the positive surprise, while both Old Navy and Gap continued as expected.
Now, it's $25 million worse potentially than the downside that they had given initially. Now, to me, at home, that's a lot of money. But to a company the size of Gap, is it that significant? How should investors think about whether this reaction is a buying opportunity or no?
I think you got to hear the call, and you want to hear about, is the momentum of sales continuing? What are they seeing in terms of the complexion of store sales and online? When you think of, is it the buying opportunity, the big brands of Old Navy and Gap still got their same sales numbers, and they should be benefiting from the marketing initiatives that they put in place, the denim campaigns that seem to be working, and frankly, the ability for them, they're capturing more consumers. The resonance of Banana Republic is something that's new. We all know about Athleta's been weak. They just brought in new leadership for the Athleta division. We'll have to see there. But the tariff headwinds, it's been hitting every single company. Tariff impacts are greater than expected in the third quarter and for the year, and pricing remains to be seen how the consumer will respond.
Well, Dana, let me ask you about Ulta Beauty. It's looking better than expected with raised guidance, I believe. What do you want to hear from the company about how much we can expect these effects to continue?
I think Ulta Beauty, you want to, the word for that quarter, it was a beautiful quarter. That's the synonym for Ulta Beauty. The quarter basically beat on sales, beat on the fact of traffic, beat on transactions, and raised the guidance. I think what you want to see is the read acrosses. Look what you've heard from others. Sephora was positive in the United States. I want to hear from Ulta Beauty. Look at some of the new initiatives, whether it's buying Space NK, expanding internationally. I want to hear about the category growth. And they said they gained market share. Each of the categories grew, sets them up very well for holiday 2025.
All right, Dana Telsey, thank you.
Thank you.
Well, Nutanix under a lot of pressure on Wall Street today after annualized recurring revenue questions about the guidance. We're going to hear from the company's CEO answering some of those perhaps next. And later, Fast Money's Dan Nathan on how to trade Tesla following a 40% plunge in European sales last month. Overtime will be right back.
play.
Welcome back to Overtime. Pure Storage posting its best day ever after recognizing its first revenues from a Meta partnership earlier than expected. Overtime viewers heard that first here yesterday in a CNBC exclusive before the earnings call with the CEO.
We started developing a business that's targeted very much at the hyperscalers. We actually were able to recognize our first revenue into a hyperscale environment just last quarter. And we believe that will continue to scale in the years ahead.
And right now in Overtime, Elastic is up 18.5% after results and guidance that beat consensus on the top and bottom lines. I spoke with CEO Ash Kulkarni about the quarter, taking share, and a guide that he described as prudent.
We beat what we had guided by about 18 million, and we raised more than that. We raised more than that for the full year. So it's a clear signal that we feel really good about the rest of the year. Now, a very interesting thing for us was this quarter, over a third of our security business came from deals where we displaced an incumbent vendor. And that's because people are trying to consolidate onto fewer platforms in cybersecurity. And we are one of the very clear winners as we've taken this, security is a data problem approach, which people are now really coming around to.
Elsewhere in enterprise software, Nutanix shares closed down 5% today after reporting a beat in Overtime yesterday, but some analysts were concerned that the recurring revenue growth seemed to slow in the guide, and I spoke with CEO Rajiv Ramaswamy today. He said shifting deal sizes make the ARR numbers look slower, but the underlying demand and growth potential are steady.
But the underlying business hasn't really changed, right? We added 2,700 customers. We continue to expect to add new customers this year at a good clip. Of the 2,700 customers that we added over the last year, more than 50 of them were Global 2,000 customers. That means the biggest of the biggest. And with all those customers, we have a lot of headroom for future expansion.
We'll get something to compare that to when we get Broadcom's numbers as it owns competitor VMware. Well, it's time for a CNBC News update with Kate Rogers. Kate.
Hi, John. A judge has set a hearing for tomorrow morning on Federal Reserve Governor Lisa Cook's request to keep President Trump from firing her. Earlier today, Cook sued the president, challenging his attempt to fire her from the Board of Governors over mortgage fraud allegations. The Fed said it would abide by court rulings, with the case likely to end up before the Supreme Court. The FAA says a grounding order for Newark Liberty International Airport has been lifted after equipment issues led to a grounding for flights into the New York area airport earlier today. The FAA said the issues interfered with some radio frequencies for air traffic controllers, and this comes just ahead of the Labor Day weekend, one of the busiest travel periods of the year. And New York needs more millionaires in the tax base. That's according to a report today from watchdog group the Citizens Budget Commission, which says New York's number of millionaires is shrinking faster than states such as Florida, and that is costing the state billions in tax revenue. John, back over to you.
I wonder why that is. All right, Kate Rogers, thank you. Well, tech stocks have been significantly outperforming the broader market since the beginning of April. Up next, we'll look at whether tech is ready to take a backseat, perhaps to some sectors that have underperformed. And later, a shakeup at the Centers for Disease Control, where one official who just resigned is accusing the White House of weaponizing public health. The latest details on this CDC crisis coming up.
Co.com.
Welcome back to Overtime. Stocks closing in the green again with the S&P 500 closing at its 20th new high of the year. Let's get a quick check on some of the biggest overtime movers. Dell falling down 4% despite a beat across the board. Marvell lower by about 8.5% after reporting weaker than expected Q3 revenue guidance. Petco popping up 13% after raising its earnings outlook. Autodesk popping as well, up 10 following a beat on the top and bottom lines. And SentinelOne is up almost 6%. Those results a mixed bag, but we will speak exclusively with the CEO of SentinelOne right here on Overtime tomorrow. Let's turn now to the broader markets. 61% of NYSE stocks are above their 200-day moving average. That's just about a year-to-date high, according to Goldman Sachs. So how should you be playing this rotation in your portfolio? Well, joining me now is Bob Kaiser, co-CIO and senior market strategist at Aspire. Bob, you say you can stick with large cap core and growth here?
We have been bullish for 2 years. We've expressed that mostly by, through large cap core exposure and also growth stocks as well. And the reason for that is where the earnings growth has been and continues to be.
An interest rate cut won't change that?
It'll definitely help the macro story, but a lot of, the Fed funds rate, for instance, are predicting over an 80% chance of a September cut, 2 cuts by the end of this year. So it's not going to move the macro needle that much, but it certainly helps.
We've been talking for a couple of years about how much certain large technology stocks are just overrepresented in their weighting in the S&P 500. Is that just a new normal? Should we get used to it? Is big just fine?
We've had to get used to it. The top 10 stocks in the S&P are like 40% of the market cap. But technology and growth, the growth slice of the S&P 500, it's the only sector this year that's going to post 4 quarters of double-digit earnings growth on 4 quarters of double-digit last year. And next year, we're looking for another year of 4 consecutive quarters, according to consensus expectations. So there is a fundamental reason why investors have embraced these stocks, and they're certainly being rewarded for it.
As much as I love talking about tech, there is more to the market. So tell me about industrials and materials here and whether we should be paying more attention.
That's the interesting thing. If you look ahead to 2026, S&P Global Market Intelligence data foreshadowing $300 a share. And we're going to see somewhat of a broadening out according to consensus expectations. Instead of double-digit earnings growth being driven by just 1 or 2 sectors, technology principally, we're also looking for double-digit earnings growth for the 4 quarters next year from tech, of course, but also industrials, materials, and even the financials, if you exclude the second quarter of next year, according to expectations. They're also looking at the possibility of double-digit earnings growth. So from a fundamental earnings perspective, there is reason to think of a broadening out, which I think we're going to need if the S&P is going to earn $300 a share, which is consensus expectations.
Any particular areas within financials?
No, we don't go that far. We invest our clients' money, basically growth versus value, core, and of course in the fixed income sleeves.
If the consumer weakens, how much does it change your feelings about that?
It's an interesting time right now because the July employment report was so shockingly weak that to me, I'm kind of thinking maybe it's an anomaly. Maybe it's a response by hiring managers to the Independence Day tariff announcements. They were very big. They sent the S&P down, remember, 12% in just 4 trading days. That could have been a little bit of a shock that went through hiring managers' minds, waiting for the dust to settle. Hopefully, a week from tomorrow, when we get the August employment report, we're back, above 100,000. But if we're into a period now of consistent weakness on payrolls, we will have to rethink a lot of our assumptions because we've been bullish for over 2 years, predominantly based on the strength of the U.S. labor market. The entire post-COVID expansion has been defined by, very strong labor demand, exceptional non-farm payroll growth, tight labor markets, wages, which boost, consumer confidence and household spending. So it's potentially a game changer, but we have a week to wait yet to get to that point.
Well, we're looking forward to it. Bob, thank you.
Yep,
Bob Kaiser. Well, software stocks staging a big comeback this week and making up ground against semiconductor stocks. Up next, Fast Money's Dan Nathan on whether there's still time to buy beaten down software names. Plus, the Russell 2000 doubling the gains of the S&P 500 this week. We're going to break down the charts to see if the small caps will keep delivering big returns for investors. That's coming up on Overtime.
Life outdoors.
NVIDIA lower today after beating on the top and bottom lines. Data center revenue came in below estimates for the second straight quarter. Is this a buying opportunity? Let's ask Risk Reversal Advisors Dan Nathan, also a fast money trader and a CNBC contributor. Dan, what do you say?
Hey, John, how are you?
I'm good.
Thanks for having me. Listen, the reaction to NVIDIA's earnings today probably was, it was warranted. I mean, when you think about it, I believe the expectations were not particularly high the way they have been over the last few quarters. Over the last actually couple years or so, we already got CapEx expectations from their largest customers. They have large customer concentration, as you know. So the idea that they were going to come in and blow out, their numbers here, it just wasn't something that I was expecting. And the fact that the stock closed unchanged. So your question is it a buy here? It really depends on what you think the course of CapEx is, what you think the adoption of AI is, what you think growth at the hyperscalers. Obviously, it's Amazon and it's Microsoft Azure and it's Google Cloud, that sort of thing. And, when I think about the market's expectations right here, I think they're probably getting a little bit excited or overexcited right now. So I don't think NVIDIA is a buy here. I've thought that for a bit. The stock obviously has continued to go higher. One of the things that I'm actually kind of keying on as we exit earnings season right here is that, Microsoft had that big beat and the stock actually closed very poorly after a huge gap and really has barely seen an uptick over the last couple of weeks. Palantir had a beat. The stock has not performed well since its earnings. Taiwan Semi, which makes 85% of those high-end GPUs that are NVIDIA's, hasn't really traded particularly well either since earnings. So I think there's going to what?
You mentioned a couple of software names in there, so I got to ask you about software. I don't know if you're dabbling at all in Autodesk or Elastic. Both of those are up big right now. What about those smaller software names? Can you buy them?
Well, I'd be more, I don't know anything about this. I'd be more focused on, a Salesforce that reports Wednesday after the close. I mean, this is a stock that has not participated in the excitement in and around generative AI, despite the fact that the CEO, Mark Benioff, has been talking about agentic AI for a couple of years now. So when they report next Wednesday, I think it's going to be really interesting to see what they're talking about, their own productivity, the way that agents are working within that company, and then the uptake that they're seeing from a lot of their customers. The other one I'd say is interesting Wednesday after the close is Figma. We know this stock just went public a few weeks ago.
I want to sneak something else in, though. I want to hear what we have to have you back to talk about Figma. I got to ask about agents who can drive. Tesla, the company's Europe sales plunged, 7th straight month of declines there. Chinese rivals, BYD, jumping. Stock's been under pressure on Tesla. People want to know about Tesla. What do you got to tell us, Dan?
Well, I'll tell you that the best days for their EV business are behind them. This is going to be the third consecutive years of negative units here. And BYD is a company that's not only taking huge amounts of market share in China, but it's also, as you just mentioned, in Europe, too. Elon Musk, he knows this. About a year and a half ago, he said if we do not put up trade barriers to Chinese EVs, that the U.S. makers, that's predominantly him, they're going to get, I think the word he used is demolished. So when I think about Tesla, if you were valuing this as an auto company, you've heard this 1,000 times over the last year on CNBC, you're probably doing it wrong because Elon doesn't want you to look there. He wants you to look at robotaxi. He wants you to look at Optimus robots. And to me, I think you take it over when those things are going to be meaningful revenue contributors to this company. So right now, the fundamentals of Tesla and their EV business have never been worse. And the competition, BYD, they're kicking their butts right now.
All right. You sanitized it for us. And you know where people should really look, Dan Nathan, especially if they want to hear your thoughts on Figma and everything else. Fast Money. It's coming up right after overtime, 5 p.m. Eastern. Dan, thanks.
Thanks, bud.
Up next, what's behind a major shakeup at the Centers for Disease Control, and what could it mean for your health and investments? We'll tell you when we come right back.
You got this.
Welcome back to Overtime. There is a full-blown crisis at the Centers for Disease Control, charged with protecting the nation from health threats. The White House is attempting to fire the agency's director. 4 other top officials just resigned. Angelica Peebles, messy.
It has certainly been a messy 24 hours at the CDC, and the White House says that President Trump has fired CDC Director Susan Minares after only about a month on the job, but her lawyers are saying that she hasn't legally been fired, so that's still a question. But like you said, John, 4 other CDC officials also resigning this week, their responsibilities ranging from chief medical officer to overseeing the office that works on vaccines and respiratory diseases. And based on everything we know at this point, it appears that vaccines are really at the center of this crisis. Now, we've seen a number of changes to vaccine policy during HHS Secretary Robert F. Kennedy Jr.'s tenure. Remember, earlier this year, he fired all the members of CDC's Vaccine Advisory Committee and installed his own members to that committee, which recommends who should get which vaccines and when. Now, that panel is supposed to meet again in mid-September, and they're supposed to take up the latest COVID boosters, routine immunizations like one for measles, and that's according to a draft agenda that we saw posted today. So much more to come, John.
Angelica, if there's a disease outbreak anywhere in the world, you know, what I learned from COVID and I guess from a lot of movies is the CDC assesses the danger to America. Is there the risk that with so many officials no longer in place, the response might be somehow affected?
Of course. Well, you don't have a director. You also just lost the head of the respiratory diseases and also zoonotic diseases. These are crises, and the zoonotic diseases person also oversees foodborne outbreaks. These are things that impact all of us, right? We never know when diseases are going to spring up, new threats. And so having those people there, people who've been there for a long time, that institutional knowledge does help, right? When you're in a crisis, you want the people that have been there who know what to do. And so not having that could, of course, put us at jeopardy. That's not to say that's going to happen, right? We don't know that something is on the horizon, but there is always that risk when you have these people leave.
Never do know when it's on the horizon.
Exactly.
Angelica, thank you. Yeah. Well, up next, we'll break down the charts to see if this mystery stock, which is up more than 40% this week, has even more room to rally. But first, check out Hormel Foods. Shares posting their worst day on record, down 13% after warning that profits could be lower than expected thanks to a steep increase in commodity costs. We'll be right back. Welcome back. Shares of Caterpillar falling just over 3% in overtime. This after the company stated in an SEC filing that it expects a bigger than expected tariff impact in 2025. Sound familiar? The company expects its full year adjusted operating profit margin to be near the bottom of the target margin range. We just heard about tariff impact from Gap. Well, it may have been a lackluster day for small caps, but the Russell 2000 is beating the major averages not just this month, but for the quarter as well. Our next guest says the index could hit a new all-time high before year end. Joining me now is Craig Johnson, Chief Market Technician at Piper Sandler. Craig, this is different from an earlier guest who was sticking with the bigger names. So what convinces you exactly about the small caps?
John, thanks for having me on this afternoon. What convinces me about these small and mid-cap names is when we go back and just sort of look at the advance we've seen off the lows, and we start looking at these Mag 7 stocks that have just been kind of treading water in here. John, we've been calling these the Lag 7 stocks for the last, call it 6 to 9 months in here. And we're just seeing a nice pickup and improvement below the surface. Stocks in here like Unity Software, you look at Howmet, you look at a lot of different names below the surface, and they're picking up. And then specifically looking at the chart of the Russell 2000, you've got a very classic inverted head and shoulders pattern here. And when you get a pattern that's this well defined and you break the neckline like we have done, you can see a measured objective that could take the index to new highs, and that would be just above 2450. But you could actually see a measured objective closer to 2600. So again, nice outperformance. And then if we do see the Fed cut, that should be a catalyst for small mid-cap stocks to push the index even higher.
What about MongoDB? It had a big reaction after earnings.
You know, Mongo had a huge downtrend reversal on a weekly chart. Certainly was solidified by the volume that we're seeing back through the moving averages. There's still decent upside from here. We would measure from a technical perspective a target about $524, so about 67% upside from where we are now. So still pretty attractive. Good upside.
You have some thoughts about United Health?
You know, United Healthcare, local company, certainly not very constructive looking on the charts. The stock has already been cut in half. It's trying to rebound. Yes, we got a lot of investors like Warren Buffett getting involved, but we've got tax loss selling coming up, which I'm sure will probably lean on the stock in here for a while. And from just a pure technical perspective, John, there's no reason to buy the stock here.
So I'm keeping in mind what you said about the Russell, about the small and mid caps. Is that an anti-large cap call or just a pro small and mid based on how they've been performing thus far?
I think it's just a more pro small mid cap in terms of outperformance. Investors can make a decision based upon style. Do they want to be up cap? Do they want to be down cap? Value, growth, etc. And from our vantage point, just looking at the charts, it is definitely, you don't need to have to sell those names. But if you're looking to buy the fastest horses in the race, it's going to be in small mid cap land, not large cap at this point.
What's the effect of that crazy move that we had in the overall markets in April?
Well, I think the effect at this point in time is I think a lot of investors have been caught off guard and during that move. I also think a lot of investors have been fighting this tape. In fact, when I go out, John, I'm talking to our trading desk and we have conversations and they give me a lot of reasons why this market cannot go higher. That's not typically the language that I have heard over the last 30 years. Typically, it's language of the market's doing great. It's going to continue to go higher. But right now, they're still fighting it. And when they're fighting it, it tells me that we're climbing that proverbial wall of worry, John, and sentiment still continues to be negative, not only from them, but the AAII names and also from the name indexes, too.
Craig Johnson, thank you.
Thanks, John.
Great look at the charts. Well, let's get you set up with tomorrow's trade today. No earnings on the calendar, but there's a lot of economic data that needs to be on your radar, including a closely watched inflation report. July PCE price index seen increasing 2.6% year over year. Core prices 2.9%. We'll also get July personal income and consumer spending reports, as well as the latest reading on consumer sentiment. That's it for Overtime. Fast Money starts now.
Live from the NASDAQ market site right here in the heart of New York City's Times Square. This is Fast Money. Here's what's ahead tonight on the big show. NVIDIA earnings, they're in the books. Jackson Hole, it's in the rearview mirror. So what? We'll be moving your money and the markets in the months ahead. We'll discuss and debate. Plus, retail reporting, Gap's numbers just crossing the wires. Investors digesting details from Best Buy, Dick's, Dollar General, and more. We're going to round out the retail trade. And the latest from the Fed drama, Lisa Cook hearing tomorrow morning, what we're expecting, and why Wall Street is suddenly seeing green on a big gambling name. Plus, EV competition in Europe, it's getting legit. We're going to talk about that and much more. Hello, everybody. I am Brian Sullivan, in for Melissa Lee once again, coming to you live from the NASDAQ Studio B. And on your desk tonight, we've got Stephen Grasso, Daniel Nathan, and Gaetano. What, is it Gaetano? What's the full name?
Well, since you asked, my father was Gaetano Marino. But I was born in 1963, as you know, and parents didn't want to name their children ethnic names, so I'm just Guy Christopher. Okay. Listen, you brought it up. I mean, you asked a question. What am I going to say when you ask me a question?
Just say Guy. And it's a miracle that Guy Adami is not ethnic, which I love.
Guy is.
But we start with an all-time high for the S&P 500 as markets keep going up. The index crossing 6,500 for the first time ever. The move's all coming as NVIDIA did not scare investors off with its earnings and guidance. The AI trade, in other words, keeps going. Yes, NVIDIA did fall a tiny little bit today. But CEO Jensen Huang making bullish comments about the future of its business in China. So with the most important report of earnings season out of the way, Jerome Powell making people believe that a rate cut is just around the corner. Guy.
Yes, sir.
Adami, what is the next big catalyst for the stock market?
Well, as Steve will tell you, you never short a dull market, and this is what we are. He'll also tell you that in the quarter end, the way the trajectory has been suggests we're going to continue to go that way. And obviously tomorrow being Friday, into a long weekend, that's what we're looking at. So it's hard to derail the momentum. But with all that said, you just mentioned all the catalysts in the rear view. They're catalysts looking us straight in the eye, coming in the form of inflation data, job data, things that can move the needle. And oh, by the way, global interest rates continue to go higher, which I don't think is bullish. So I understand it. I get it why the market's going higher. People are very optimistic about things. But the things that I've been concerned about have not gone away.
Yeah, it's interesting when you look at the Faithful 8, so that's the Mag 7, Sully Plus, Broadcom, the disproportionate amount of their sales comes from outside the U.S. So you think about the fact that dollar is making new multi-week lows here. It's very, it's off of 110. This is the Dixie trading below 98 right now. And they don't have a whole heck of a lot of exposure from the tariff situation, right? So if you think about these large names, let's call them the top 10 in the S&P 500, they're benefiting from a weak dollar, rates going lower, and not having a lot of tariff impact. So if they're huge contributors to the performance of the S&P 500, but also from the earnings and the earnings growth, that could be a bit of the tailwind and one of the things that's kind of keeping the S&P kind of moving slightly higher almost every day.
So, Steve Grasso, what do you think, in your mind, your big brain, will be the next catalyst for this market?
The Fed Reserve meeting, right? So
that's
just a little thing. And to Guy's point, you never short a dull market, you never sell a dull market, but when you look at seasonality, these are the weakest months of the year.
September, historically.
August through October is the weak, but not cataclysmic weakness. It's just maybe you don't want to invest around that time. Maybe you want to pick up some bargains. For me, I think it's all about the Fed. Are they going to cut 25 or are they going to cut 50? I think that's the biggest thing. Now, love them or hate them, President Trump is going to give us something in the next couple of months. So they're not going to be dumb. There's going to be a headline. There's going to be another state.
We get a headline every day.
Exactly. So we really can't be a boring market anymore. And you have Lisa Cook. You have the Fed Reserve meeting. A lot to keep us all busy.
Yeah, and I do. It's not a normal news cycle, so I do wonder. We got breaking news in a second. I do wonder, Guy Adami, going into a long holiday weekend, it used to be just take it off, relax. I don't know with this president. We're getting headlines out of the White House every day. He doesn't care. It's a Friday going into a 3-day weekend.
No, he doesn't, and it's interesting. I'm glad you said that because he has now equity in the equity market. And what does that mean? With an S&P 500 at an all-time high, he has some chips that he can play with. So if he wants to lower the boom on a holiday weekend in terms of tariffs or anything else, now's the time to do it, given where the S&P 500 is, because he's trading from strength, not from weakness. And historically, if you go back and look, when the market's at its highs is typically when he can ratchet up the rhetoric. So I wouldn't be surprised to see something over the weekend.
All right, I do have some breaking news. Got a news alert right now. Reports of a new CDC director. Angelica Peebles with that. Angelica.
Hey, Brian, the Washington Post is reporting that the White House has selected Deputy HHS Secretary Jim O'Neill as acting director of the CDC. Now, we have reached out to HHS and we'll let you know if we can confirm that news. Right now, this is according to the Washington Post. We're citing people familiar with the situation. Remember, just yesterday, we heard the reports that the White House was removing CDC Director Susan Minares from her position. It's still a little bit of a tricky situation where her lawyers are saying that she has not actually been legally removed from that job. The White House is saying that she is indeed out, and apparently they have named her replacement. So much more to come on that story, and we'll keep you posted with anything else we can share. Brian?
So just to be, Angelica, just to be clear, so we have a purported firing of Susan Minares yesterday. She says, no, I'm still in the job. But now the White House has reportedly named a new. So theoretically, right now there are two heads of the CDC, or two people who are considered heads of the CDC.
Theoretically, that is what's happening. But again, the White House is saying that she is out and they have a new person in. Well, that's what the Washington Post is reporting. They have not confirmed that they do have a new head. But theoretically, there are two. But again, it's a little bit like the Lisa Cook situation where you have someone saying, I was fired. The White House is saying that we're firing someone. That person saying you can't fire me. So it's a little bit of a tricky situation. But last we heard, her lawyers are saying that she indeed has not been fired. But the White House is saying that they did go ahead and take that step.
Oh, it's getting real out there.
Complicated.
It's complicated, but it's also not. Somebody says I'm not fired. Angelica, thank you very much. The president says, here's the new head of the CDC. Susan Minares says, and this is, by the way, this is going to happen at the Fed.
Which is
this is going to happen with the Lisa Cook situation.
That's what Steve was talking about. I think it is important. And again, listen, I'm not here to arbitrate guilt or innocence. I mean, that will hopefully be adjudicated in a court of law. But I will talk about is the impact I think it should be having to our bond market, because the entire structure is built on confidence. And if you start to have any concern about the independence of a Federal Reserve, I'm not suggesting people won't buy our bonds anymore, but they can demand a higher rate of interest to do so. We're not seeing it at all. I want to be crystal clear. You mentioned it last night. The bond market doesn't seem to care. It should start caring, in my opinion.
And that would be a sell-off of U.S. debt?
I think that's a sell-off in the bond market. I think that's interest rates going higher. I'm not suggesting
Just rattles confidence
what we saw in early April when the bond market was melting down on one random Tuesday night. I don't think we're going to get to that point, but you get something close to that for sure.
And to Guy's point, if you look up on the screen right now, we've seen no effect of it. The market is not paying attention to it. The equity market is at all-time highs. The Treasury market is the yields are not rallying. So the market seems to be treating it as if it's a non-event. I get Guy's point. One day it won't be a non-event, but right now it's a non-event for the marketplace.
Okay, so let's go back to what is an event for the marketplace. And by the way, we'll get more on this Lisa Cook situation in moments. But for more now on the record highs and the AI boom, let's bring in Joe Cusick. He is portfolio specialist at Calamos Investments, coming to us from one of my favorite places, the SIBO. Tell everybody there, Joe, that we said hello. Love that place as well. Very quickly, I'm not going to ask you to dive into the politics of it, but are you surprised that all this brouhaha around the Fed is not impacting bonds of the markets?
A little bit surprised, but no, because you've seen that we've had mispricing and volatility as far as the implied and what's actually realized. So, as an old options trader, this is basically what we expected. The market doesn't care, and it hasn't, and it's not, and it's steady as we go, and that mispricing has been in place for a while.
And the VIX, the so-called fear gauge volatility index, which really just sort of measures options pricing and spreads, that's not indicating any nervousness at all. But when the VIX is this low for this long, Joe, I guess I've got the old options trader sort of semi in me as well, because that makes me nervous.
Yeah, well, yeah. I mean, look, I saw some of my old buddies that I used to trade with down here. Look, the Spidey senses are up. The level of complacency, I've been talking about it, as a hedged equity strategist. The bottom line is that we are concerned, because navigating this complacency without any guardrails to the downside, it absolutely scares me. And institutions have to stay in this market, and retail, well, they're starting to feel like they might have to chase a little bit. So right now, that complacency in the VIX is something that over time I have found throughout my career is a little bit of a yellow flag at this point in time.
Yeah, I agree with you, Joe. And I think the market participants have realized that the sell-offs don't last that long. Just go back to April, lasted maybe 3 or 4 days. And I think the game now is that, you know what, we're going to continue to sort of full speed ahead, as you just said, because we'll be adept enough and quick enough to exit if, in fact, an event comes. And I think that's where the market is at this point. Of course, you know, having done this for a long time, markets go down a lot faster than they go up. And we saw glimpses of it in April. We haven't seen anything since. Anything on the horizon? Steve mentioned seasonality into September.
Yeah, you know what? Look, I see some yellow flags coming up in the energy sector. I still see that the institutions are buying puts en masse. The skew has really come up, and we've actually seen recently that put spread activity is really kicking up. So coming into September, while we've seen that the trajectory is still to the upside, we're at all-time highs. You can't debate that. You're starting to see positioning that's continued with institutions hedging en masse and buying calls in lieu of buying underlying. And you're seeing retail now coming in and doing put spreads in things like the S&P 500, using hedged equity strategies and so forth, because there is a lot of uncertainty that's starting to grow, even though it's not reflected in volatility.
So, Joe, in your career and in my career, we've watched institutions run the market. Now we've seen retail lead in the market. How do you address what you look at? What are your signals now that retail investors are actually moving the ball, not institutions?
Well, first of all, you're going to see a lot more speculative moves. In other words, you're going to see option volumes through the retail shops start to increase notably. And we're starting to see that. It's starting with spreads, and we're going to continue to watch that. The other thing is, too, is that you're basically going to start to see that the transition into looking at the unloved stocks, the ones where it goes beyond means, but it's going into spaces that haven't had a lot of love, and seeing that's where the retail is going to show up. I think that the institutional side is fully vested at this point in time. We've seen that. We continue to see that. But that's where you're going to start to see this movement to more of a broad-based move. That's where retail's coming in.
All right, Joe Cusick, SIBO. Love Chicago, Joe. Tell everybody at Series downstairs who said hello as well. Great to have you on the program. Thank you very much.
Thanks.
14.5 VIX, Dan Nathan. That's got to even make Dan Nathan a little nervous.
Well, let's just put some context into this. If you're looking at the SPY, that's the ETF that tracks S&P 500. You look where it's trading right now, 649. That's basically tracking the 6,500 that the SPX is trading at. You can buy an at-the-money put in September 19th expiration, which gets CPI, PPI, and it gets that Fed meeting. It costs 1.25% of the underlying. Just think about that. If you want to make a bearish bet using options on the SPY and you want it through all those events to September expiration, third Friday in September, it costs you 1.25%. Think about that. Like, it's just absolutely insane. And just especially when you think of this, the apathy that's going on, not just the markets and everything else. You talk about these headlines that we're getting 3 times a day. No one cares. At least through the markets lens, you can see that too. So it's really cheap to buy protection. We say this all the time, though, that if you're doing this too frequently, it's a really big drag on on returns. So the idea of doing it tactically, and this could be the exact time to do it, makes a lot of sense.
Would you consider that a risk reversal?
No, a risk reversal if you did this, if you sold a call, bought a put, or something like that, that would be a risk reversal.
And that's your options action.
May I ask you a question?
What's that?
What is this establishment that you speak of? This Siri? Is that what you said?
Series.
Is that a bar?
It's the god of, it's a restaurant, diner, and the ground floor of Randolph Street, SIBO. It's the god of fertility or something.
Okay, you're saying it in anger towards. I'm asking you a question, and you're angry at me. I mean, they might be watching the show right now. You're probably friends with the bartender.
It's a diner.
Oh.
They have a bar.
May I say something intelligent for
yes,
once in 18 years? Gold market is clearly telling a much different story because gold seemingly is impervious to everything. In an environment where, if you think about it, gold should be actually selling off if equities have done better. Yields coming. I mean, there are a lot of reasons to think that the gold market should be faltering. It's not. It continues higher. Silver does as well. Gold miners participating. Bitcoin, although not significantly off the all-time highs, has sold off. So there are strange things under the surface if you're paying attention.
All right, we are paying attention. And everybody out there that's watching and listening, because we love our radio listeners as well, Sirius XM.
You do. You mention them all the time.
Because there's a lot of people that listen on the radio.
No, but it's not a visual
They never
thing.
get acknowledged.
Well,
I love them
radio
too.
listeners. If
I
you're
love them
driving,
all.
2 hands on the wheel.
Roman
pay
goddess of
attention.
agriculture.
Cheapest
Meantime,
thing you can do.
A hearing set for tomorrow morning in Fed Governor Lisa Cook's request to block President Trump for firing her. Steve Leisman has more. Steve.
Good afternoon, Brian. The legal outlines of one of the most important cases in Federal Reserve history becoming clear today with the filing of a lawsuit by Fed Governor Lisa Cook to overturn her firing by the President of the United States. Cook called her firing, quote, a clear violation of law and asked a judge for an emergency temporary restraining order to allow her to keep her job and perform her duties. She asked for, quote, a declaration that governors can only be removed, quote, for cause, a declaration that an unsubstantiated allegation does not constitute cause, saying if it were, the president could remove any Fed governor for any allegation. She wants an injunction against the Fed and Powell from carrying out the president's, quote, illegal attempt to fire her. Cook contends the Fed's independence is at issue if the president can fire a governor based on allegations. The president said in the letter firing Cook 3 days ago that the mortgage documents he had seen shows, he said, that Cook claimed 2 primary residences and that was sufficient cause for removal. The president wrote, quote, there is sufficient reason to believe you have made false statements on one or more mortgage agreements, adding that her actions raise questions about her competence and integrity. So the legal battle lines have been drawn. The president says he can fire her based on what he's seen and what she did before she joined the Fed. Cook responds, these are only allegations, not related to her actions as a Fed governor, and that it's all part of an effort to take over the Fed and set interest rates. A hearing on the request for the restraining order set for 10 a.m. tomorrow in D.C. District Court. Brian.
Steve Leisman will finally let you sign off. Been on the air since this morning. Steve, we appreciate it. Steve Grasso, it's a family show, so I'll keep it clean. It's a honey badger market. It doesn't give a you-know-what. And the reality is VIX at 14. Dan's talking about how cheap it is to buy protection on this market. Why doesn't the market seem to be rattled by anything?
Well, first of all, there's a huge channel of open-endedness with the Lisa Cook issue. Right? We don't know whether she's going to be removed, so the market is probably looking through that. President Trump has said he's not going to remove the Fed chair, so the market is looking through that. The market continues to go up. Everyone thought tariffs were going to put a lid on the market. We're going to crush earnings. That didn't happen. So the market just seems to be looking through everything, and a static investing process has been going on, and I think that's what people are sticking.
Because ultimately, I think you would agree with this guy, Dami. The S&P 500 is simply a collected measure of future estimates for earnings, and earnings estimates continue to go up. At the bottom line, that's what the stock market is.
That's fair. I mean, we're still probably trading at 22-ish times next year's. That's historically about 4 turns higher than we've been. The CAPE ratio, for those that care, but the Shiller PE, the cost-adjusted PE, is now trading at levels we haven't seen historically. In 1929, it was 31. It's 39 now. It's the second highest reading in history. The Buffett indicator, he's still the greatest investor of our lifetime, is now north of 200%. 210%. He gets concerned at 130%. There's no valuation cushion whatsoever in this marketplace. So, as Dan would say, have at it, passive investors, but you've bid this market up to levels that we basically have never seen before.
Have at it. The best buy in the market right now are the September at-the-money puts in the SPY. I'll just be very clear about that.
Is that 1.5% cost that you just referred to?
It's like 1.1%. Let's
1.1%.
Let's review this.
And where does that
September
stand
19th.
Historically? How cheap that is?
Really low.
Really, really low.
And I think the guy from the SIBO, what he mentioned is that the skew is getting people want more calls than puts. It's usually the other way around.
What does that mean?
So it means that calls are more expensive than that of puts. If you're looking at an equal out of the money, and I know we're getting into the options action stuff, but just understand that they're reaching for calls more than they're reaching for puts.
And does that tell you, again, welcome to Options Action, everybody. Does that tell you anything?
What were you just like defrosted from like a million years and under the thing or something? What it tells you is normally people buy put protection all the time, and rather than just buying calls. So it's just speaking to a bit of a euphoric market.
Skew, put call skew. For you people listening on the radio.
By the way, once the show's over, listen to The Frozen Man by James Taylor. It's a fantastic song. It's off Copperline.
Or watch your film Encino Man.
Whatever happened to Brendan
Fraser? He won an Academy Award.
Oh, for The Whale.
Yeah, sure.
Fantastic. All right, coming up, a lot of action happening right now, as you can tell. Some of that's actually even in the market. From Dell to the Gap Payments Company, Affirm. We're going to get details on all ahead. Plus, the surges in Snowflake and Pure Storage, and why one firm is upping the ante on shares of Wind. Fast Money returns, hopefully, right after this break.
You're watching Fast Money here on CNBC. We'll be right back.
AI meeting agent.
All right, welcome back. Let's talk Dell. Shares of Dell are down a bit right now. The earnings call started last hour. It is still underway. Christina Partsenevelos has more on Dell, a stock that's down a little bit over 4%.
Yeah, and the reason is because the investors are focusing on the miss for the Q3 guide. The guide came in a little bit light, but when you look on a full year basis, it's better. So that means that in Q4, it's really going to be back or last quarter heavy. The company said the reason for that is storage, and that'll add to profitability. It's going to see some improvement. Specifically, they're starting to see also some improvement in North America. That is one of their most profitable businesses. They said it was weak, especially coming from the federal side. Why do you think that is? Doge. And I'm sure the narrative that Dell wanted was they are shipping double the amount of AI servers this year, $20 billion. So, that's a huge other portion of their business. For those that don't know, Dell they buy NVIDIA chips, they package them together into AI servers, and then they sell said servers to customers like CoreWeave, for example. And
That's literally, by the way, what Michael Dell did in his dorm room to start the computer company Dell. He assembled computers and then resold them he's just replicating the model that made him one of the world's richest men.
Well, when you're doing something right, why not continue?
That's my point.
And so just to point, storage is quite bad. It fell 3% on the quarter. It seems like a lot of analysts were focusing on that. But they are quite bullish on AI, and they're saying specifically a lot of Blackwell backlog. And overall AI backlog is about a little bit less than $12 billion.
And Guy Adami,
yes, sir.
The headline will be the stock's down 4%. But let's be clear. This was a $37 stock 2.5 years ago. Now it's down, and if you're on the radio, I'm doing air quotes.
Again with
down to 120.
Again with the radio.
Down to $128.
Yeah.
So let's not make too much of a 4% down move.
I mean, the 7 people right now are in just gleeful.
So I have a long.
I don't want to make a big deal of it. I'll say this. People will look at valuation, say it's reasonable. And it is reasonable on valuation. It also is one of these things that can become somewhat commoditized as well. I'll say this. Razor thin margins, I think 7.8% operating margins. It's not that it's not a good company. It's just that valuation might be a bit, I don't know, bit of a sort of a red herring to me. 144, Steve will speak to this. Go back to November of last year. Go back to early August of this year. Bit of a double top. I think you sell the stock here.
Yeah, and to Guy's point on technicals, if you look back to April 7th, it's been in an uptrend. It has not really broken down substantially. I would say the closest we came down breaking down was about a week ago, and then the stock is back off again. The question is, do you want to buy an AI stock or do you want to buy an AI peripheral stock? And that's what Dell is. It's got a number of levers to pull, and it's not a direct AI play. It's got a multitude of facets that involve AI.
Yeah, so 40% of their sales in the way, Christina just laid it out. I mean, obviously this ISG part of their server business is growing, fast. But the problem is that if you see a digestion in some of this CapEx, these are going to be probably one of the first companies hit kind of hard. We know that, what is that SMCI? What is it called?
SMCI.
Okay.
Super micro.
If super micro.
That's helpful.
You said razor thin margins. They're like half of that of Dell. So they're always going to be out there underpricing Dell. So this would be one of the first companies hit if you do see a pullback in CapEx.
Yeah, and to your point, they're still highly exposed to just the regular PC market, and we can't forget that. So that's the whole cyclical nature. The refresh was a lot slower. Windows 11, we're all supposed to change our computers. We haven't really done that yet. Why not? You're not impressed that maybe things will improve in Q4?
No, things can always improve. Absolutely, things can always improve. But I'm just looking at
well, that's
where
what they're
the stock
saying.
was.
Their guide is saying that.
You know what? They all say that, and things are improving. You listen to what Jensen said last night. He tells a great story, but things may not improve. And if things do slow down in this economy, one of the first things that's going to cut is CapEx. And who gets hurt in a CapEx thing? A company like Dell.
What do we talk about?
We're talking about NVIDIA. You said, why are we talking about Dell for 4% down? We talked about NVIDIA all day, and that stock wasn't even 1% down.
I guarantee you, if NVIDIA went, and Dan, Nathan, correct me if I'm wrong, if NVIDIA went down, all these stocks are going down. Every single one of them.
We hit a lot of highs today, and 70% of the tech S&P tech sector was closed higher.
I agree. I'm taking her side on this. I
There's
think
no side.
By the way, I don't. No. It's
every stock is a buyer and a
That's what the show is, Brian.
That's fair.
So I do believe there's a scenario where NVIDIA could sell off and the rest of the market can rally, like today. That happened today. So is it an extended thing? Can it happen in an extended fashion? I believe so. I think there's a way that the Mag 6 can all rally and NVIDIA could sell off. Yes, I believe that.
So Marvell is down in the aftermarket right now. They make custom silicon. They are a competitor for all intents and purposes of NVIDIA. And this is a stock that's massively underperformed the stocks. Next week, I think we're going to get the Broadcom that comes out, what, guys?
AVGO.
AVGO. And so that'll be a really interesting. So if we see like these small little misses in data center, that's what happened here in Marvell. That could be the thing that causes some of these stocks to start cresting.
Cresting. I like that. All right. Yeah. Christina, thank you very much.
It was spirited.
Good luck.
Yeah, she's good at what she does.
Now to another big technology name, Snowflake, soaring 20% today. It's best day in nearly a year. It also beat the street. We talked about it a little bit last night when the numbers came out. Now, Snowflake, it's interesting. Dan, the stock is well off its highs of 4 years ago. Well off its highs, but it's also well off its lows of last year. So how do we read Snowflake?
Yeah, I mean, listen, this is one of these very unique plays within this generative AI. And one of the things I'll just say is you're seeing the trade kind of broaden out a little bit. So as we get into some of these software earnings, you better see some of these companies being rewarded for it. And, I was on John Fort's show. What do they call that thing?
The overtime.
The overtime, the OT. And we were talking about this just for like 30 seconds, though. Next week, we're going to have Salesforce and we're going to have Figma reporting after the close on Wednesday. These have nothing to do with Snowflake. I want to be really clear. But as the trade is broadening out, is trying to find new ways to express it. It'll be interesting to see how investors react to what they have to say about their contribution or the productivity gains that they're seeing from generative AI. So to me, that's the thing that I'm most focused on here.
Were you here last night? You were.
I was.
You recall we talked about the Snowflake.
We did. I just said that.
I know. For the radio audience, in case they're not paying attention.
Stop it.
We said there's a very good chance it trades up to the February of 2024 high, which was about 242, 243. Look at the screen. Here we are. Today it traded 41 million shares, 10 times normal volume. Valuation makes 0 sense. If you've enjoyed this run, in my opinion, you're taking money off the table.
Well said. All right, coming up, why one Wall Street firm says you got to up the ante on Win. And it may not do with what you think it does. You're watching Fast Money Live for the NASDAQ market site. We are back right after this. All right, UBS giving Win a win today. It raised its rating on Win to a buy, and it's not because of Las Vegas. It has to do with Macau, China, and also a huge new resort that Win is building in the UAE near Dubai that is really going to change the entire complexion of the region. Guy Dami,
yes, sir.
Win's had a good year. It's up 47%. Now, this resort, obviously in the UAE, it still needs to be developed and built and have customers. It's going to open in 2027. But, wow, they're really bullish on Macau.
As they should be, and I think people are starting to figure it out. If Tim Seymour was on the desk, he would speak wax poetic about it. And I still think, despite the move, there's room to the upside. A lot of very influential people have been taking stakes here. One of your dear friends is probably watching right now. We've been talking about it the last couple of weeks. Contessa does a great job around the space. They're late to the game, but it doesn't mean they're wrong. I think Win continues to go higher from here.
Yeah, I mean, I agree with everything that guy said. It's just if you look at MGM, I just pulled up MGM on my screen. It's definitely underperformed. Win is, you nailed it. They're looking at the luxury property at the UAE. They're banking on that. They have a high debt level. They took out money to finance the UAE project. MGM has exposure to online gaming. Mm-hmm. Win does not. Granted, MGM is a very, very small online gambling exposure, but it's growing dramatically. And Win, it doesn't really have it there. So If you want a luxury gaming casino name to play, you stick with Wynn. If you want to play something that is a little more conservative and has a much better valuation, you go with MGM.
Well, they're different companies, though. Wynn is going for the high end to that point. I mean, this thing they're building in the UAE and one of the Emirates, it's not in Dubai and it's not in Abu Dhabi. It's only 2 Emirates of the 7 anybody can name. Carl Shira is the third one that they're building this in. Ras Al Kharma, excuse me.
Looks magnificent.
It looks amazing.
You could have said anything, and I would have nodded my head.
My point is, they're really, this is going to change. It's on a man-made island about 50 minutes from Dubai. It's going to change the complexion. If it works, it's going to, I think,
it's a hell of a commute for you to go to that casino.
A long commute.
Their price target is 147, I think. If you go back to March of 2021, I think that's where we topped out at. I think that's where it's going, Brian, and good for them. They're taking a shot. They're gambling. They should gamble if you think about it.
See what you did there?
See what I did there?
I see what you did there. All right, coming up, we are going to fall into the gap as those shares fall.
Missed a moment of Fast? Catch us anytime on the go. Follow the Fast Money Podcast. We're back right after this.